Your brand new iPhone deserves the best protection, and the iLune 3-pack screen protector plus 3-pack camera lens protector has you covered. Don't take risks with your iPhone. Click the link in the video description to shop now on Amazon.
What's happening to U.S. assets? We're seeing a dramatic shift in investor favor as President Trump's aggressive trade policies take their toll. The 7-day realized volatility of the S&P 500 has surged from an annualized 50% to 169%, according to data from TradingView, which is the highest level since the coronavirus crash in 2020. Bitcoin, on the other hand, has seen its 7-day realized volatility double to 83%. While it's still volatile, Bitcoin remains significantly lower than the S&P 500. In fact, the cryptocurrency looks less volatile even when looking at a 30-day basis. This raises an interesting question. Should investors place their trust in assets that are highly susceptible to political influence and human error, or in a mathematical framework and emerging store of value that's more resilient to such risks? We've seen the S&P 500 crack 14% in less than 2 months, largely due to trade war fears that have recently come true. The tech-heavy Nasdaq and Dow Jones Industrial Average have suffered similar losses alongside increased volatility in global equity markets. Risk aversion of this magnitude has historically led investors to park their money in treasury notes, which underpin the global financial system, and the U.S. dollar, the global reserve currency. But since last Friday, investors have aggressively dumped treasury notes, driving yields higher, and the dollar index has tanked. The so-called benchmark 10-year bond yield has surged by 62 basis points to 4.45% since last Friday, and the dollar index is now at its lowest level since late September. Typically, when national bond yields rise, currencies appreciate, but in this case, we're seeing a currency depreciation. This is highly abnormal for the U.S., with only 4 episodes in the last 30 years where the dollar has depreciated more than 1.5%, with the 30-year yield up more than 10 basis points. The shift away from U.S. assets and towards alternative investments, like Bitcoin, is an interesting development. As Omkar Godbole, co-managing editor on our markets team at Bitcoin Bulletin, pointed out, this reflects evaporating U.S. growth exceptionalism and the reduced attraction of dollar assets for reserve purposes amid erratic U.S. decision-making. So, what's next? Will investors continue to flock towards more resilient stores of value like Bitcoin, or will they find new haven in other asset classes? One thing's for sure, the cryptocurrency is gaining attention as a potential low-beta hedge against stocks.